on, everybody? Good morning and welcome back to Beat the Bell presented by Kane Capital. Hope you guys have all been having an awesome week inside and outside of your trading. August has greeted traders with some pretty nice volatility, which is a switch up from July, which just seemed to be a green market day every single day. Now it's more of a trader's market, but that's all right because we've been prepared for it. All right, let's get into this morning's panel, starting with Money Mander. Money Mander, good morning.
Good morning. Prepared for it and executing it, kind of exactly what we were expecting to get in August. But happy hump day, and we'll get into Fed forecast in a second.
All right, Diamond Trades, good morning.
Alejandro, what's going on? I don't know that the price action in August has been necessarily better than July, but I guess we can dive into that in a little bit here for sure.
All right, let's do it. Fed forecast and economic calendar.
Yeah, so we'll start with the economic calendar for today and the rest of the week. So far, we really haven't had a ton of data, and today is going to be no different. We really don't have much on the schedule. Tomorrow, we are going to have CPI at 8:30 before market open, and then we're going to have some Fed speakers in the afternoon, as well as initial jobless claims before market open. And then on Friday, we're going to get additional inflation data with producer price index, as well as core PPI with Michigan consumer sentiment at 10. So the news cycle will get a bit heavier here towards the end of the week as things heat up. So far this week and so far for the month of August, as I sort of just mentioned, we've continued our rocky start, right, in these first 2 days of trading, as well as some headlines related to bank credit and Chinese exports sent stocks lower and bond prices higher yesterday. So yesterday, the S&P 500 shed about 0.4%, the NASDAQ dropped 0.8%, and the Dow was down 0.5%. Since Friday's close, the healthcare sector has been the strongest on the back of positive earnings from drug maker Eli Lilly, which rallied the stock 15% yesterday to an all-time high. Their weight loss drug that they released recently has been absolutely crushing it on sales, and so that lifted Eli Lilly stock as well as the entire sector there. So healthcare leading the way so far. Let's go ahead and touch on one of the bigger pieces of unscheduled news that we got so far this week was the Moody's downgrade of several U.S. banks, smaller U.S. banks yesterday. So yesterday before the open, Moody's, one of the three major credit reporting agencies, downgraded several smaller U.S. banks while stating that some other larger institutions are still under review for potential downgrade in the future. Capital One, Citizens Financial, Fifth Third Bancorp, and others were downgraded by one rung, while M&T Bank, Pinnacle Financial, BOK Financial, and a handful of others fell into the negative outlook territory. Among the larger lenders that are under review, BNY Mellon, U.S. Bancorp, State Street, and Truist, all major players in the investment and consumer banking space. Moody's analysts stated that U.S. banks continue to contend with interest rate and asset liability management. Asset liability management risks with implications for liquidity and capital as the wind down of unconventional monetary policy drains system-wide deposits. Adding many banks' Q2 results showed growing profitability pressures that will reduce their ability to generate internal capital. This comes as a mild U.S. recession is on the horizon for early 2024, with particular risks in some banks' commercial real estate portfolios. This downgrade is really like an extension of the regional banking trouble that we witnessed in late Q1, early Q2, when Silicon Valley Bank and Signature Bank collapsed, triggering a run on deposits that shook the entire sector. That even caused the Fed to respond, opening up their credit facilities, as well as actually doing that one rate hike pause in the midst of their hiking campaign, and sort of just let things cool out in the regional banking sector. That seems like this is sort of a carryover of that sort of episode that we had way back in March. The Fed's tightening campaign has put increased stress on banks' abilities to match up assets and liabilities, and with rates looking like they're going to remain higher for longer, there's definitely reason for concern in the financial sector. We continue to expect a mild recession in early 2024, and given funding strains on U.S. banking sector, there will likely be a tightening of credit conditions and rising loan losses for U.S. banks. That is what Moody's analysts said, along with the downgrade announcement. XL left the financial sector ETF from State Street. Was down nearly 2% yesterday, while KRE, the regional banking ETF, was down 4%, I believe, at its worst, before both of them pared losses into the close. So A really rocky day yesterday for financials. After that news, they were able to sort of rebound there before the close. But Mander, what do you make of this second credit rating action that we've seen in 2 weeks here? First, obviously, last week with Fitch downgrading the United States government credit one rung, and then today, or yesterday rather, Moody's coming in and not necessarily downgrading the government credit, but downgrading some smaller bank credit, and then looking at some larger banks. I mean, you look at the names that they have on their list there. What was it? State Street, BNY Mellon, U.S. Bank Corp, Truist. Like those are like not small banks, and so it's interesting to see that not just the regional banks, but some of these larger institutions are actually still under review there.
Yeah, I think the Fitch thing with the U.S. government, we talked about that on Monday. I think that was more bogus than this. I think Moody actually has decent cause here to at least give them a downgrade. I don't think they're saying these are high risk banks that are likely to go under, but I assume they were probably credited very highly. As you said, they're major banks, major players in the industry.
Right. So those four that I mentioned, BNY Mellon, U.S. Bancorp, State Street, Truist, those are all no credit action or no rating action was taken against those names. They're under review right now to see if there's going to be a rating action going forward. They did take a rating action on Capital One, Citizens Financial, Fifth Third. And then you had M&T Bank, Pinnacle Bank, and BOK Financial all fall into, so with their credit action, all actually fell into negative outlook territory, as opposed to like coming from the highest rung to maybe like, just one rung lower as a downgrade. They're now, actually in negative outlook territory for some of those banks.
I think for these lenders, this is really just going to be an effect of the mass time we've seen with this yield curve inversion, because as a lender, that's typically how they would make money in the long run, would be shorting, or what do? They long further out treasuries and then sell the closer one. But when you have this inversion with usually they're probably running like a 2 and a 30 year. But right now you have the inversion really across all treasuries. I think the longer this goes on, that's really where this is gonna, like you said, this is really net paring those loan revenues. That's really how they make most of their money, especially as a lender. You don't have massive deposits. You're making most of your money on the inversion, not on the inversion, on the yield curve spread there. And so when that's inverted, the longer this goes on, I think, the more likely this is for them to get a downgrade. And we'll see really if this turns into any more bankruptcies moving forward for these. The one thing I wanted to cover, you hit on this the first thing, and then you nailed it with recession. China, we got some really actually surprising news coming out of China, which completely contradicted what we saw here in the States. So coming out of their post-lockdown COVID situation here, recent CPI numbers posted out of the second largest economy here in the world showed deflation, on paper deflation, much to the contrast of what we had here. So instead of experiencing surges in prices like we saw as people came out of the pandemic and had kind of that pent-up demand to get back into the economy, obviously we had stimulus providing that as well. China's suffering this unusual bout of falling prices as commodities with steel, coal, daily essentials, and consumer products, food, and home appliances, all of these went negative on a year-over-year basis when they posted their CPI numbers. So I'm kind of curious here, while falling prices in China, they could help inflationary pressures elsewhere with us, with Chinese exports coming around the world cheaper now. They also could become kind of a source of another concern for our domestic profits and kind of the strength we've seen in our own personal economies if these products start getting flooded with cheaper products out of China. So I'm curious to see how this moves forward. Obviously, we had 3% here in the States on CPI. The EU is still sitting at 6.4%. And now China comes in at a negative 0.3%. So we're seeing major divergence here between these major economies that kind of drive the entire global trade here. So moving forward, I don't know. We continue to get worse. This was the other thing. China's exports to the rest of the world tumbled in July. Global exports out of China dropped 14.5% in July, the steepest year-over-year decline since February 2020, and exports to the U.S. and EU plunged by more than 20% last month. So I think it's kind of still too early to tell kind of what this impacts on the globe, but either do you think this pulls down the global economy with the U.S. and the EU kind of falling in that suit, or do you think this is an effect rather than a cause? Because post-pandemic, I think a lot of these Western economies grew their own domestic infrastructure, their own domestic production, so they wouldn't have to rely on China after seeing how that impacted our supply chains and how reliant we were on those Chinese exports. So do you think this is more the effect of that, or do you think this could be cause for concern for us falling suit?
I think there's one of the primary factors that you would have to look at is definitely like the tensions between China and sort of the Western world when you look at the Taiwan situation over the last several years really. And it seems like it's always sort of been their plan to obviously become the largest economy in the world. But what makes that so difficult is how intertwined our economies are, right? Like it's very difficult to overtake our economy when we're like one of their biggest trading partners. And so it's a situation where it seems like they're doing their best to really to really be seen as that optimal resort to the rest of the world, right? I mean, when you look at like the BRICS alliance, things like that, it seems like that's what they want to be, right? They want to be like that knight in shining armor for the rest of the world to say, hey, look, like, we should be your primary trading partner. You don't have to go through the United States to do everything. And at the same time, they make a lot of their economy benefits a lot from the Western world, from the United States, from Europe, in terms of their GDP growth and their exports. And so it seems like they're fighting two wars on one sense, where it's like you want to get the most out of the emerging markets and really sort of really solidify your trade ties with those countries. At the same time, frictions are rising, tensions are rising with your current largest trading partners in the United States and in Europe. And so I feel like that's really like the storyline here with what we're seeing out of China. Like you said, the area that was hit the hardest was the exports to the United States and to Europe in the last month. And so it'll definitely be interesting to see how that develops going forward, and see if rising geopolitical tensions, play any sort of factor into that as we move forward here, for sure.
That was all I had. We'll send it right back to Alejandro. That'll wrap us up here.
All right, awesome. Thank you, guys. We're going to take a look at the S&P. If you guys remember, on Monday, we drew this zone on the show, right? And this was just a simple back test zone, or the breakout zone, I should say, from when we broke out on July 12th, okay? And I mentioned this would be a really important area for bulls to hold. Clearly, we've held that so far this week. Going to talk about that a little bit later on in the show when we take a look at a futures chart as well. But taking a look at SPX here, we can see that we held important support. That was just a breakout and back test, simple technical analysis. So we've still been unable to climb above the 50 SMA on both the 30-minute and the 1-hour chart. The market is still sort of in that sell the pops mode. So it would be nice for bulls to see clearance of those 50 SMAs that would resume the uptrend. But bulls, as I mentioned, have stepped in exactly where they needed to. Hopefully you have this area outlined on your chart, because we held exactly where necessary. All right, guys. Now we are going to quickly transition into Bet the Bell. And I'll be manning the ship this morning. So let's dive right into it. First, taking a look at the stats. Nothing has really changed there. Diamond narrowly ahead.
Holding the lead, baby.
Big slip.
Love that.
I was the Lone Ranger to the red side on Monday.
Yeah, that was rogue.
Hate to see it.
All right, Diamond, green or red?
Let's see, green. Today's gonna be weird. We don't really have like any news, and like we talked about, we've got like the major economic news coming towards the end of the week, particularly tomorrow with CPI. So I feel like today you definitely see some choppy price action, but I'm gonna go with green.
All right, Mander.
I'm also going to take green to what you just mentioned on the system segment. I think we rallied right out of that demand zone that needed to hold yesterday, so I think we could see some continued upside.
All right, I'm going to go green as well. All right, question number 2. With car payments at a new all-time high and credit card debt now surpassing $1 trillion, could a recession be possible in the near future? Thoughts, starting with Money Mander.
I'll take it away first. I think it's kind of relevant because we were just talking about how Moody's put this out that they're forecasting a 2024 recession. I don't think we get one. And if we do, it's not going to be because of these headline articles that we're getting with the credit card debt. It was a lot of things that we've actually touched on the show here. The one segment the one statistic I just saw recently though that kind of contradicts all of that is while credit card debt is at all-time highs, the amount of debt versus capital in deposits and capital in banks is at an all-time low. And so really all we're seeing is that credit card debt is at the highs because the GDP and the economy is growing, and debt is obviously going to trail that. But I think the ratio of credit card debt to like deposits held within banks at like 6% right now, which is at all-time lows. And so obviously there's still cash in the bank. People aren't holding credit card debt as a last resort, at least in the grand scheme of things right here. So I think we actually get out of this one.
Yeah, I'm going to piggyback on that. If you look at the St. Louis Fed actually put this out, the household debt service payments as a percent of disposable income. So sort of just to Mander's point, like not just the cash that you have in the bank, but actually the disposable income that you're receiving every week versus how much you're actually paying out in terms of debt service every week is also at like a multi-decade low. It's sitting between 9 and 10%, the lowest that we've seen really since like, you know, the 90s. So, I mean, while credit card debt is definitely rising, obviously that seems to be the case, and that sort of is what everybody's pointing at. Like, you know, the world's on fire. The world's on fire. It doesn't seem like it's having a massive impact on consumers' ability to pay off their debt. I mean, in terms of at least, you know, how much they're paying to debt service relative to how much disposable income they have, it just doesn't seem like that really is causing too much stress on the consumer right now.
All right. Appreciate the responses. Now, the last question. Could Bitcoin reach $180,000 by 2024? Unusual Whales recently tweeted, Bitcoin could soar to 180K before the April 2024 halving, Fundstrat has said. Thoughts on this, and then I'll give my thoughts. At the end, we can go back to Noah.
Yeah, I mean, Tom Lee's a dog. We got to see Tom Lee in person, Alejandro, when we visited the stock exchange. Guy definitely knows what he's talking about. 180 is that said, 180 is kind of crazy. 180 is kind of crazy. From, I mean, where are we trading right now? Like in the 20s, if I'm not mistaken.
29.
Yeah. I don't personally see 180 in the cards. I'm sure he has a good reason for saying that. But that would just be no. I don't think so. I think too many regular people would stand to make too much money if Bitcoin went to 180K. I don't think that the powers that be are going to let that happen. They can't let that many regular NPC folks make a ton of money. I don't think that they're going to let that happen, unfortunately.
All right, Mander. Let it be said, that would be like a 500% run up from where we're at right now. And the last bull market cycle we saw in Bitcoin went from like 10 or 12 to 70 or 69 or whatever. Pretty much the same. It was like a 500% run up. So I think this is too close of a time frame, and I don't stand to act like the crypto expert, but if you know that like Bitcoin does that halving thing, like that's how they create more coins until they get to whatever that max threshold. There's like a set number of Bitcoins that they've stated they're going to create. And I think we're getting to the end of this halving process where we're going to be at that max level. There won't be any new Bitcoin mined. Like they're going to run out of code in the blockchain to make any more. And I think at that point, that's really where you get a parabolic squeeze here. If there's not any more code to be creating new Bitcoins in the hash or however this thing works, you're at max Bitcoin, right? There's no more supply. There's only demand. And so that could really drive this thing.
What the fuck are you talking about, brother?
Okay, so picture there's
like code in the blockchain.
There's like 20 numbers and letters that make up, and so you like exponentially do the math on that. There's only a set amount of Bitcoins you can make. There's only like 1 through 9, and there's A to Z on each thing. And so eventually, once you have a Bitcoin for every single one of them, there's no more that can be created. And we're getting to
the simple supply and demand equation.
Yeah, and we're getting to that point where there's only going to be demand, no more supply.
All right. Well, do you think it's going to happen?
No.
By 2024?
No, I don't.
21 million, by the way, is the maximum number of Bitcoins that can ever be created. Is 21 million, and I think it says that there are 19 million in circulation, and so there's approximately 2 million left. So that's what Mander's talking about.
Wow, we're getting close.
Yeah, we're getting close. That was from March 23 that there were 19 million left. So I'm sure that there are 2 million left. So I'm sure that there are less than that now.
All right. So I don't think that we're going to 180K by 2024. Seems pretty outrageous. That being said, I'm going to go ahead and buy some in case that does happen. because, I mean, as Mander mentioned, the times that this thing has gone parabolic, it's just gone so nuts so fast. And I'm not sure I want to be the guy. I mean, to me, Bitcoin, I was actually thinking about this morning, funny enough. It just kind of feels like it's just sitting on a launch pad. Like it's been consolidating for so long at this 30K, and it's going to do something soon. So I'll say no on the 180K by 2024, but I am bullish on Bitcoin. All right, guys, that's going to do it for Bet the Bell. Next, we're going to do some Market Moron.
All right, let's take it away. I need your guys' take on this one. I saw this video a few months ago. It just popped back up in circulation. I was looking at this. This was a person that does personal finance and budgeting for other clients, third party online. Some client came to this person and said, here's my breakdown each month of what I make and my expenses. And this was just a quick screenshot. I forget what they were making. The couple was 2 corporate lawyers, I believe, spending over $75,000 in monthly expenses, which obviously that can be taken like a million different ways. Depends how much money you're making. To some people, that's probably a drop in the bucket, right? The kicker was they had like $40,000 in cash savings and then like minimal sitting in stocks or any investments. So basically they were making a ton, probably making, I don't know.
I think it says at the top there, is it 77? Is that their income?
Each month and spending 75.
That's insane.
That is insane. What's your guys' take on that?
Go back to the picture. I want to break this down.
You want to go? I don't know.
Yeah, sure. I mean, the thing is, like, you hear about stuff like this, right? Like, you hear people say, you know, it's not about how much you make, it's how much you keep. It's not about how much you make, it's about how much you could save and invest. I didn't know that there were people actually doing stuff like this. When you have $4,000 allocated for fun, you have a $2,200 car payment. I mean, what car are you leasing? Like, that's insane. A $10,000 nanny. The sad part is, you know, these kids have to think that their family is just loaded. And clearly, you know, the family probably thinks that they're loaded too. But my God, yeah, this is a really good example of the difference between being rich and being wealthy, and how a lot of times what we see from the outside when you look at somebody, and I'm sure this family, as I mentioned, has the nice car, the nice house, you know, everything. They have the nanny. I mean, it seems like they have all the money in the world, but when it really comes down to it, they have very little money. And unfortunately, this is a lot of this is the case for a lot of people that don't understand budgeting and the power of investing. And
what's the mortgage? I would hope the house is nice.
My God, yeah.
I mean,
$29,000 mortgage. I mean, that's just unbelievable.
So even given Ryan, if you throw it up, given the craziest stuff on this little budget here, what really stands out to me the most is 4K on personal trainers. That to me is the craziest thing. Like, you could say what you want about the mortgage. Maybe the house is extremely nice and a really nice place, and they think that the value is going to appreciate. Sure. Say what you want about the cars. Maybe, you know, for what they do for their jobs, it matters to keep up appearances, and it can actually get you more business, right? Say what you want about all those things. 4K on a personal trainer is crazy. I don't care who you are. Like, if you're not playing like a professional sport, what is that? Where you're spending 48K, $50,000 a year on a personal trainer? Like, you actually better look like LeBron James. It just doesn't make any sense. Like, how I don't care how much money I'm making. I just can't see myself dropping 50K a year on a personal trainer. That's number one. Number two, I was gonna come after the 10K for the nanny, but I don't have kids, and so I can't, you know, maybe that's unfair. Maybe that's the current market price for a nanny in this environment. I really,
it's not unfair, and it's not the current market price for a nanny.
I had a feeling it wasn't, but I don't want to judge because I've never been in that position, and so I mean, 10K to me seems kind of crazy for a nanny, but you know, to each.
If that's the case, none of us are having kids.
I was about to say to each their own. I will say that they've got. I like the allocation of subscriptions. Only $200 a month on subscriptions. So like when you look at like
reasonable.
Yeah, like that's a pretty reasonable. Like I think that they got one. They got one thing right on here, and that's definitely the subscriptions there. And so keep it up there. But yeah, this is just not good. And I said this before we brought up this question. I said this to the guys when we were talking about it. I personally don't believe that people like this are real. I think that this is somebody who makes this up to like go viral on the internet, and like there's no way that actual people are doing that. Like that's just I don't believe it. I'll believe it when I see it. I need that couple to come out and out themselves, and then show me the house and show me the car and show me the nanny, because the nanny better be like 120 for a nanny, bro.
You could probably get Fran Drescher for 120 a year.
That's
crazy. $14,000 between dining, shopping, and fun money. And so I think really the thing to take away from this is they're broke. And as Alejandro mentioned, they'd like 40,000, like they'd be out on the street in 1 month should anything happen with their business, with their job. And so the age-old tale, like it's not a money problem, it's a spending problem. And I think that's like the thing to take away from this.
Live 100%. Update: Bitcoin just cracked 30K. Hondo, while we were talking.
That's because I just bought it. I just broke 30K psych level.
It's like Kramer when he posts a buy rating.
Except the opposite. All right. Last but certainly not least, we're going to cover trade of the week.
It's time for America's Trade of the Week.
Now, here's a guy who knows how to trade stocks.
All right, quickly here, guys. I mentioned that we were going to take a look at the S&P futures. Here's the chart. On July 12th, we broke out, started the massive rally of like 150 points or so. That was back in July. Okay, July 12th breakout. Now, this is a level that I've been eyeing as we've slowly been selling off to start August, which, also important to mention that August seasonally is a weaker month. It's typically a flat month over the past 20 years, returning 0.1%. So no surprise here that we're starting to pull back and consolidate, but keeping an eye on this like 44.95-ish area. Very, very clear level of resistance there that we broke out over. You guys can see that on Friday, we came back down and we back tested that level and we got about a 40-point bounce. So that was back test number one. Now, typically how things work in the market is they don't work smoothly, and you don't just move from one price level to the next, because that would be way too easy for everybody. So what the market has to do is it has to set traps in order to create liquidity, in order to really send price. And so we got that initial bounce, but then yesterday we got a very sneaky flush below that breakout level, which looked like a failed back test. Okay, so as we can see here, we flushed below Friday's low, that 44.93. We trade below it. This does a couple things. It traps shorts who look to short on the break below a key support level, and it stops out longs who had their stops just below that key support level. So what I was waiting for was a move below this level and then a recapture, and that is the entry to get long. So you're taking advantage of the traps. So I got long at 45.02. We're currently sitting at 45.25 in the pre-market. So a really nice trade, up about 23 points. I'm still holding on to some of my position. Now, admittedly, I was a bit late to this trade, but that's because I don't trade during lunch. So ideally, I would have liked to get it a little bit lower at around 44.95, but it is what it is. And the trade ended up still being a winner. So nice lesson there on false breakdowns. That's going to do it for this morning's show, guys. Appreciate you guys tuning in. We'll be trading live all day in the Kane Capital Discord. You can go to kane-capital.com or scan the QR code that's about to pop up on the screen. Beautiful. Hope you guys have all been having an awesome week. We will see you back here on Friday morning at 8:30 a.m. Eastern Time. Have a good one, everybody.